Yo guys, it's John here with Option Lab. In this video, I'm going to be talking about how, if my back was totally against the wall or as a total beginner, how I would make $500 a week with high probability options strategies that I've been trading. So how this came up is a bunch of you guys who joined my free Discord, link down below. Highly suggest you get in there. I chat with each one of you personally, one-on-one. I've been having a lot of good talks, and one of the questions I've been getting asked is, how do I implement these strategies for a smaller account? Now, keep in mind, this advice is for any account size, but this one I want to focus on smaller accounts. And a few of you dummies in the comments have been asking me to show my account because it has a lot of money in it. So people are always skeptical. So what I'm going to do here is go to my account, and just to establish a little credibility here, I will go into my positions so you guys can see the position page, refresh it, and I'll go to transactions just so you guys can see that I'm trading on this account, and you can see all of the options I'm doing. So naked puts, more naked puts, some calls in there too. So anyhow, let's get back to the video. So what would I do to make $500 a week trading high probability options? And this is going to be a lot easier than you guys might think. So step number one in the process is you have to be approved for level 3 options trading. So there's 4 levels typically that we think of. Number 3 is going to give you option spreads. So if you're trading on a really small account, we're not going to worry about naked contracts for now. So we're going to be mostly playing with bull put spreads, condors, that type of thing with a smaller account size. So I'd say get approved for level 3. That's going to allow you to play these strategies that I'm about to talk about. Step number 2, we want to find high IV stocks, high IV, with upcoming earnings or a recent overextension. So using tools like the RSI, the MACD, the screener, stocks that might be hitting a 180-day low, anything that has high implied volatility, because with high IV, since we're option sellers, we're selling to open options, higher implied volatility means higher option premium and the more money that we're receiving for opening those trades. So in my Discord, I talk about kind of like how I scan for these in other videos, but for simplicity's sake, high IV stocks with earnings or recent overextension. And overextension simply means that we're playing for a correction. So if a stock is overextended to the downside, we might sell a bull put spread below it, anticipating that it bounces in the short-term future. And the same thing on the upside. If it's overextended to the upside, selling a bear call spread in anticipation that's going to go down. So I drew out 3 examples here of how I would do this. So let's do that now. So step 3, selling. This is actually how we're going to pick the criteria of the legs that we're going to choose for our spread. So we're going to sell a 0.20 delta or lower option that's super far out of the money, and we're going to either do a spread, a condor, or a naked option. So what does this mean? So if we were to draw this out, so if this is your stock and it looks like this, so selling an option, you want to pick the strike price that you think it's going to stay above, and we'd sell a put here, and then to protect ourselves, we'd buy a put one leg below. And if you guys are totally new to this is going to sound confusing as hell. So that's the general premise. 0.2 delta means that leg that we're selling, it has about an 80% chance that it stays above that leg by expiration, and we keep our premium. Super easy. So let me go through kind of like how I mapped this out. So here I drew up 3 trades today that would fit our criteria for making $500 in a week. So this would require a total of 3 clicks, would require absolutely no management, and it would just basically be clicking to open and kind of just monitoring. So number 1, FedEx. FedEx has an upcoming earnings report. So what I did was I found the put option that has the put strike price that has a 0.17 delta. So that's about an 83% probability that it stays out of the money by expiration and we keep our premium. And what I did was I created a spread. So I sold the 255 and I bought the 252.5, right? So that creates a 2.5 point spread. You collect, as you see here, $150 for doing so, and that $150 is an 83% likelihood. All right, on to the next one. And again, if you're totally new, this is going to sound confusing as hell. So talk to me in my Discord. I'll hop on a call with you guys, whatever you need. Next, this is a naked put. So SMCI, going through a little bit of trouble right now, but overall there's some bullish news and research on it. So what I laid out here was selling one of the SMCI 30 puts. So for this, as long as it stays above 30 by expiration, you collect $100, and as you can see here, that's a 75% likelihood based on that option, that strike price having a 25 delta. Okay, great. So now we're at, and actually I meant to say two of these, so minus two of them. So that's $200 plus 150. We're at 350. And to finish it off, we're going to go with MSTR. Bitcoin's been obviously super volatile, at least recently, with the election news and just the overall sentiment on crypto. So with this, I sold 3 vertical spreads. So this is a put spread. So I sold, let me draw this out. I sold, what's going on here? I sold -1. Let's get that stupid box out of there. Escape. Okay, there we go. So I sold -1 of the 360 put and then bought the protective leg below it to create a bull put spread at 357.5. Keeps a nice tight width between our legs. And as long as that stock stays above 360 by our December 27th expiration, we keep a net premium of $150, and that is 79% probability trade. So if you see here, I'm picking up small wins, but they're high probability, and these stack up to a nice $500 in 3 clicks. Super easy. I understand if you're new to this, it's hard to follow these strategies, but like I said, shoot me a message in my Discord. I'll help you guys through it, but I just included a screenshot here of the chain to show you guys that I have delta on my option chain, and I look here to see what strike prices have what deltas. So in this case, I chose the 30s, which you could see here has a 0.26 delta. It's about a 74% likelihood. And as you can see, you can go down further, right? So if you went down to here to the 14 delta, it'd be an 86% probability. But obviously, as you increase your probability, you're not going to collect as much premium. So typically, I find that staying within the 20 delta to 30 delta range, you get enough premium and you still minimize the risk. And that's what I said here. Why are we choosing high IV stocks, selling far out of the money? Because the implied volatility gives the further out of the money options higher premium, but it also keeps our risk pretty limited. So I hope that helps you guys. And as always, if you have any questions, link is in the description. Hop in my free Discord, shoot me a message, and I'm happy to help. See you guys in the next one.